Interim Reporting Part 2. To provide more timely information, the Securities and Exchange Commission requires quarterly statements from publicly traded companies in the U.S. Just a reminder, this is not required under GAAP. GAAP only requires annual reports, but the SEC requires quarterlies. These are called 10-Qs. Now, there's two possible approaches. The discrete, which is used under the international standard, says that you only record something when it happens. So if you pay bonuses in December, you record them in December. Under the interval approach, we treat the accounting period as a portion of a longer period. So, for example, if you have bonuses, then you would prorate them throughout the year. So, it's FASB ASC 270 that requires that U.S. corporations use the integral approach. Now, revenues in interim reports are recognized in the interim period in which they are earned. Revenues from long-term contracts should be recognized using the same methodology. Now, LIFO liquidation, you have to avoid this. That is, when you do cost of goods sold, when you're using LIFO, you transfer out more units than you originally had in your minimum inventory, and you plan to bring it back up. And I'll show you an example of that. That's a no-no. And for lower of cost or market, inventory write-down should be reflected in the interim period numbers if the market value is not expected to recover by year-end. Otherwise, you wouldn't show it, and you wouldn't make any adjustments for variances unless you assume those are going to carry out through the year. Now, let's take a look at an example and it shows you an example of what LIFO liquidation is. So in this example right here, we bought units at an average cost of $50, and those were what were sitting in beginning inventory. And then during the first quarter, we purchased another 5,000 units with an average cost of $80 each. And then we sold 5,300 at an average price of $100. And we now know, based on going out to buy some more, that we're going to have to pay $82 each if we were going to buy new ones. Now, if the company plans to keep the inventory low and actually bring it down to 500 units by year end and maintain that level, then what we can do, and again we're using LIFO, so first cost in, last cost in, or the first cost out. We're going to first take 5,000 units at 80, but we can liquidate the inventory with the 300 units times 50, since we plan to bring that inventory down to 500 by year end. And so that would be our cost of goods sold. Now, what if instead we plan to increase the ending inventory to 1,500 units by year end and have that be our minimum level? Then we cannot use this pricing, because otherwise it's called LIFO liquidation and it's not acceptable under generally accepted accounting principles. Instead, what we'd have to use is the replacement cost of $82 to come up with the value of the ending inventory. Now, let's take a look at interim reporting as a whole. What we have to remember is we use the integral approach, which means that we have to allocate our costs over time. An example would be if you pay bonuses in December, what you have to do is prorate it through the year and not wait until December to book it, because otherwise it makes your information volatile. What you want to do is leave the volatility of your financials to when something actually really happens. Okay, other items. Unusual items should be reported separately in full in the interim period in which they occur. Income taxes should always be prorated, estimated, then prorated, and they also do that under the international standard. And a change in accounting principles should be reported as if it occurred in the first period of the year, but it is treated as an adjustment to beginning retained earnings. So let's take a look at an example. We had reported 100,000 in the third quarter, and we had and this included reductions of 20,000 of a $40,000 unusual item, and 16,000 cumulative effect based on a change in accounting principle, and also a $12,000 reduction for annual property taxes, and that's a quarter of what is due of a total of 48,000. Now, I would like to remind you that there are no more extraordinary items. I know it says that in the book, but we don't have them anymore. They have gone away. So now we just call it unusual item. And they're shown pre-tax, not post-tax. But in this example, we're showing net of tax. All right, so we start with our third quarter. We reduce it by the other 20,000 of the unusual item, and we add back in the cumulative effect of the change, and that gives us a new adjusted net income, and we don't do anything about the property taxes because those are treated correctly. Now let's take another look, but let's look at these financials. They're being this is what this company looks like. The first quarter includes $120,000 for annual insurance and administrative expenses, and advertising covers the whole year, and the tax rate is 35%. So this is what it would look like. As you can see, we have prorated the insurance, the advertising, the executive bonuses, and the provision for bad debt, and the annual maintenance, so that we could levelize our income. And this is what it looks like when you use the integral approach. Now, what do we have to disclose in these quarterly reports? We have to do 4 segments. We have to show revenues, intersegment revenues, revenues from external customers, segment profit and loss, total assets, and that's from doing our 3 tests we discussed in part 1. So you have to also show that information as part of the quarterlies. There are no interim disclosure about major customers or geographic locations, so you don't have to disclose that. Now, as a reminder, under the international standard, we have to use the discrete period. That is, if we had bonuses in December, we'd book them in December. Expenses are recognized in the quarter they're incurred, and they're not estimated even though they benefit the whole year, and the only exception is income tax. So that ends interim reporting part 2.